The year is 2025, and the headlines are screaming. Billionaires are going broke. Skyscrapers stand half empty. Lines of credit are frozen. Hedge funds evaporate like morning mist. It looks like the collapse of the elite. But while the 1% hemorrhage wealth in public, someone else is quietly getting richer. Not flashy, not loud, not featured in the tabloids. This is the era of the liquid rich, the ones who understood leverage, liquidity, and risk, and never confused wealth with status symbols. When the tide went out, the difference between survival and ruin became painfully simple: cash in hand, smart assets, and optionality. These survivors are the quiet cash kings. They are not tech bros sitting on $20 million in illiquid startups. They are people who treated money like oxygen. They bought businesses that generated real profits. They invested in real estate that paid rent regardless of trends. They kept liquidity front and center: cash reserves, usable credit lines, and flexibility. While others rode the roller coaster of unicorn valuations, they quietly collected interest, dividends, and rent. In 2025, as panic spreads through boardrooms, the cash kings are calmly scooping up assets at fire sale prices. Skyscrapers sell for pennies on the dollar. Companies beg for capital. Startups scramble to survive. And they have the only advantage that matters: cash. Not all tech entrepreneurs were wiped out. The ones who survived didn't chase hype. They built profits first. SaaS companies with recurring revenue, logistics firms solving real-world problems, industrial AI delivering measurable returns. When the unicorns imploded, these businesses didn't just survive, they consolidated. They bought competitors cheaply, expanded market share, and emerged stronger as others collapsed. It was a brutal reminder that profit beats perception every time. The new rich also don't live inside a single economy. Their money moves across borders: Asia, Africa, Latin America, Europe. While US commercial real estate and tech bubbles burst, globally diversified investors simply shifted focus. Supply chains in China and Southeast Asia absorbed talent and capital. African critical minerals surged in value. European luxury real estate quietly became undervalued. These investors didn't panic when Wall Street bled. They looked elsewhere and kept moving. There's a final irony in who survives. You don't have to be flashy to win. The remaining 1% are quiet, unsexy, and invisible by design. They drive modest cars. They live in functional homes. They avoid debt traps and over-leveraged lifestyles. While flashy millionaires collapse under the weight of appearances, the quiet rich grow stronger in the chaos. The collapse of 2025 delivers a simple lesson: cash is king. Illiquidity is lethal. Lifestyle inflation kills faster than a market crash. Global diversification isn't optional, and the loudest players are usually the most fragile. Survival isn't about how much wealth you have on paper. It's about how flexible, liquid, and unemotional your wealth really is. As the 1% fractures in public, the quiet survivors are rewriting the rules of wealth in private, while the headlines chase bankruptcy stories. So while billionaires cry over empty skyscrapers, grounded private jets, and exploding lifestyle costs, the cash kings are buying the world, one undervalued asset at a time. And if you want to understand how to play the game without going broke, this is exactly where the real lesson begins.
The richest recession describes a situation where even the ultra-wealthy can face liquidity crises during economic downturns. This phenomenon stems from their wealth being heavily invested in illiquid assets like real estate and private businesses, which cannot be quickly converted to cash. Market downturns reduce the value of investments, and leverage or debt can become problematic if asset values fall. Business ventures may suffer, and unexpected expenses or tax obligations can further strain finances. To manage liquidity, the ultra-wealthy can diversify investments, maintain substantial cash reserves, use leverage prudently, review budgets, and seek professional advice. Investment strategies during recessions include value investing, dividend investing, dollar-cost averaging, focusing on strong companies, investing in bonds, and real estate. Recessions often worsen wealth inequality, disproportionately affecting lower earners through job insecurity and inflation, while the wealthy may benefit from distressed asset prices. Ultimately, understanding the causes of liquidity challenges and implementing proactive strategies are key for high-net-worth individuals to navigate recessions.
By late 2025, the noise became unbearable. Every screen screamed the same story: billionaires in trouble, funds imploding, iconic towers handed back to banks.
It felt historic, cinematic, almost satisfying. For years, the public had been told the rich always win. Now, suddenly, they weren't. But history doesn't move to the rhythm of headlines. It moves quietly, in boardrooms with no windows, in phone calls that never leak, in deals signed when nobody is looking. While attention was fixed on spectacular failure, something far more important was happening beneath the surface. Ownership was changing hands. Not dramatically, not publicly, but permanently. This was not the end of wealth. It was a transfer. And the winners were not the loud, visible elite of the 2010s. They were disciplined, liquid, boring, and patient. The kind of people who never trend, never posture, and never explain themselves. The crash didn't kill capitalism, it purified it. The great liquidity separation. Every financial collapse creates a myth. In 2008, the myth was recklessness. In 2020, it was a virus. In 2025, the myth became greed. But the real dividing line wasn't morality. It was liquidity. Two types of wealthy people entered 2025. Only one survived intact. On one side were the paper rich, people with enormous net worths locked inside assets they couldn't sell without destroying themselves. Private equity, venture capital, trophy real estate, long-duration bonds purchased when rates were near zero. They looked rich. They felt rich. But they were brittle. On the other side were the liquid rich, people who understood that wealth without mobility is a liability. They held cash not as a failure of imagination, but as a weapon. They owned assets that paid them monthly. They structured their lives around resilience, not appearances. When credit tightened, the difference became fatal. The paper rich panicked. The liquid rich waited. Banks didn't ask philosophical questions. They asked for collateral. And collateral that can't be sold quickly is not collateral at all. Credit committees rewrote the rules overnight, and suddenly, yesterday's safe asset became today's unacceptable risk. Liquidity wasn't just king, it was law, the death of financial theater. For decades, wealth had been performative: bigger homes, louder lifestyles, more visibility. Money wasn't just something you had, it was something you displayed. Instagram turned net worth into theater and financial discipline into something almost embarrassing. That era ended brutally. By 2025, financial theater became a liability. Visibility attracted scrutiny. Lifestyle attracted risk. Anyone advertising wealth was assumed to be leveraged until proven otherwise. The truly wealthy went dark. They deleted social media. They sold conspicuous assets quietly. They shifted from prestige investments to cash flow machines. They stopped trying to look rich and started trying to stay rich. Private jets were replaced with charter memberships. Staff was reduced. Homes were consolidated. Expenses that once seemed trivial were examined with surgical precision. Not because they had to, because they understood what was coming. The people who survived the crash didn't downsize out of fear. They did it out of foresight. When banks stopped being friendly. Banks are friendly in one environment only: abundance. When money is cheap and defaults are rare, banks sell dreams. They encourage leverage. They reward optimism. Risk departments become flexible. Exceptions become routine. Then conditions change. By 2025, banks were no longer partners. They were predators. Quiet, polite predators with spreadsheets and deadlines. Relationships no longer mattered. History no longer mattered. Only numbers mattered. Credit lines were reduced not because borrowers failed, but because models changed. Loan-to-value ratios were recalculated using pessimistic assumptions. Stress tests assumed worst-case scenarios. If your wealth depended on bank generosity, you were already finished. The liquid rich had assumed this outcome years earlier. They never trusted permanent kindness from institutions built to protect themselves first. They treated banks like weather: unpredictable, unavoidable, and never emotional. The new aristocracy of cash flow. In the old world, net worth was the scoreboard. In the new world, cash flow became the only metric that mattered. Monthly inflows, predictable revenue, low volatility. That's where power consolidated. Industries once considered boring became dominant. Logistics, waste management, energy infrastructure, regional housing. agricultural processing, data centers, water rights, ports. These were not Instagram assets. They were survival assets. The liquid rich didn't chase exponential upside. They chased durability. They bought things people couldn't stop using, even during recessions. When others begged for refinancing, they reinvested. When others sold at losses, they accumulated. The new aristocracy didn't look rich. They looked invisible. The psychology of survival. Financial collapse exposes psychology faster than spreadsheets. Panic reveals belief systems. And in 2025, belief systems shattered. The paper rich believed markets always recover quickly. They believed central banks would save them. They believed prestige assets were inherently safe. The liquid rich believed none of that. They believed cycles are brutal. They believed institutions protect themselves. They believed survival beats growth. Most importantly, they believed boredom is a superpower. While others chased excitement, they embraced monotony. While others chased returns, they chased control. They slept well, not because they were fearless, but because they were prepared. Why this transfer will never reverse. Wealth transfers usually shock the public. This one won't. It's happening too quietly. Assets aren't being seized. They're being sold. Not publicly, not dramatically, but systematically. Every forced sale strengthens the buyer. Every margin call shifts ownership. Every refinancing failure transfers control. Once assets move into strong hands, they don't move back easily. The liquid rich are not temporary winners. They are the next permanent class. They will own infrastructure, housing, energy, logistics, data, water, land, and they will do it without headlines. What this means for everyone else. This isn't just a story about elites. It's a warning for anyone building a future. Liquidity is not laziness. Debt is not neutral. Visibility is not success. Growth without resilience is a trap. The lesson of 2025 is not don't take risk. It's take survivable risk. The next decade will not reward the boldest. It will reward the most adaptable. Final closing, the silent winners. History will remember the bankruptcies, the failed towers, the fallen names. It will not remember the quiet winners. They don't give interviews. They don't post charts. They don't explain their moves. They simply acquire, consolidate, and wait. While others mourn the end of an era, they are building the next one. Silently, patiently, permanently.